I need you to put down your phone. I need you to close that YouTube short you are about to watch. I need you to focus on what I am about to tell you, because this is not a prediction. This is not a forecast. This is not a theory about what might happen next week or next month. This already happened. And it happened so fast that most people still don't understand what it means. Ladies and gentlemen, this is your host. The event that we said was impossible just became inevitable. The arbitrage window that kept the global silver market balanced for decades is collapsing in real time. And the proof is in the numbers that just hit the screen this morning. Let me give you the data, because data does not have an agenda. Politicians have agendas, central banks have agendas, but mathematics is the truth. On Thursday, January 16, 2026, silver spot price in the United States hit $92 per ounce. $92. That is not a typo. That is not a glitch in the system. That is the actual traded price on American exchanges. Now here is where it gets interesting. At the exact same moment, the Shanghai Gold Exchange was trading silver at $99 per ounce. $99 in China, $92 in America. That is a $7 spread. Now you might be thinking, $7, so what? That is less than 8%. Markets have spreads all the time, but you need to understand what this $7 number actually represents. Because 6 weeks ago, that spread was $14. Shanghai was trading at 89 while New York was at 75. $14. We talked about that in previous videos. We said that the spread was unsustainable. We said the arbitrage was broken. We said something had to give. And what was the Western price? It exploded upward. Let me explain why this is the most important signal in the silver market right now. For the last 3 months, since China implemented the export licensing system on January 1st, the assumption was that China had locked up all the silver. The assumption was that the East was hoarding and the West was going to be left behind. The mainstream narrative was that Shanghai would keep trading higher and higher while New York stayed suppressed, because the big banks could keep selling paper contracts to hold the price down. But that narrative just died, because the American price did not stay suppressed. It jumped from $75 in December to $92 in January. That is a 23% move in 6 weeks. Do you understand what that means? It means the paper market is losing control. It means the big banks that have been shorting silver for 15 years can no longer hold the lid on. It means that American buyers, American industrial companies, American investors are waking up to the same reality that the Chinese figured out 3 months ago. The physical metal is running out. And when the metal runs out, price becomes irrelevant. Availability becomes everything. Now, let me connect the dots for you, because the mainstream financial media is reporting the American price surge and the Chinese price as two separate stories. But they are not separate. They are two sides of the same coin. And that coin is a global supply crisis that is accelerating faster than anyone predicted. Here is what actually happened over the last 6 weeks. When China closed the export window on January 1st, it created a wall between East and West. The arbitrage traders who used to buy silver in New York and ship it to Shanghai for a profit could not do that anymore. The bridge was blown up. So the two markets started to drift apart. Shanghai went to 89. New York stayed at 75. Everyone assumed that was the new normal. But then something unexpected happened. The American industrial buyers panicked. Companies like Tesla, Apple, and Samsung, they all have manufacturing facilities in the United States. They all need silver for their production lines. And when they saw Shanghai trading at $89 while New York was at 75, they did the math. They realized that if they did not secure their silver supply now, they would have to compete with Chinese buyers at Chinese prices. So they started buying. Not paper contracts, physical metal. They started calling dealers, they started emptying the vaults, they started taking delivery on every available ounce. And that buying pressure pushed the American price from 75 to 92 in 6 weeks. This is the panic buying phase, and we are only at the beginning. Because here's the thing that most people do not understand. The $7 gap between 92 and 99 is not a stable equilibrium. It is a temporary pause. The gap is going to close, and it is going to close at the higher price, not the lower price. Let me explain why. The Chinese price of $99 is the physical price. That is what you have to pay if you want actual metal delivered to a warehouse in Shanghai. It includes the cost of refining, the cost of shipping, the cost of navigating the export licensing system, and most importantly, the scarcity premium. Because in China right now, physical silver is scarce. You cannot just walk into a vault and buy 1,000 ounces at spot price. You have to pay up. The American price of $92 is still partially a paper price. It is the price you see on the COMEX futures. It is the price that the ETFs are using to value their shares, but it is not the price you actually pay if you want physical metal delivered to your door. If you call a dealer in the United States right now and try to buy a monster box of American Silver Eagles, you're going to pay a massive premium over that $92 spot price. Dealers are charging $15, $18, and $20 over spot. That means the real American physical price is already $110 or more. So we have three prices right now. The COMEX paper price is at 92. The dealer's physical price in America is 110. And the Shanghai physical price is 99. And here is the key insight. Those three prices are converging. The paper price is being dragged upward by the physical demand. The American physical price is catching up to the Chinese physical price. And within weeks, maybe days, all three prices are going to meet somewhere north of $100. That is the arbitrage window closing. That is the moment when the global silver market admits that the era of cheap silver is over. Now you might be asking, why is this happening so fast? Why is the American price surging now in January? What changed? The answer is fear. The industrial buyers are afraid. They saw what happened in Shanghai 2 weeks ago. They saw the delivery failure. They saw that 98.4% of the requested silver could not be delivered. And they realized that if Shanghai cannot deliver, the COMEX is next. So they are front-running the collapse. They are buying now before the system breaks completely. This is not speculation. This is survival. Because if you are a company that needs 10 million ounces of silver in the next quarter, and you wait until the COMEX fails to deliver, you're not going to get your metal. You're going to get a cash settlement check. And you cannot build a product with a check. This is why the $7 gap matters, because that $7 gap used to be $14 6 weeks ago, and it will be $0 in the next few weeks. And when it hits zero, when the American price equals the Chinese price, the entire world is going to wake up to the reality that silver is trading at one price globally. And that one price is the physical price, not the paper price. The COMEX futures will become irrelevant. The ETFs will become suspect. The only thing that will matter is who has metal and who does not. We need to look at what this means for the vaults and why the COMEX is about to face the same crisis that Shanghai just experienced. Let me show you the exact numbers that prove the COMEX is next. Because while everyone is watching the price on their screens, the real story is happening in the vaults. And the vault data is screaming that we are days, not weeks, away from a delivery crisis in New York that will make Shanghai look like a practice run. The COMEX registered silver inventory, the metal that is actually available for immediate delivery, stands at 28.3 million ounces as of January 15th. 28 million ounces. That sounds like a lot until you compare it to the open interest. The total open interest in COMEX silver futures right now represents 640 million ounces of paper claims. 640 million ounces. Do the math with me. 640 million ounces of claims divided by 28 million ounces of physical metal equals a ratio of 22.8 to 1. That means for every ounce of silver sitting in the COMEX vaults, there are almost 23 paper contracts claiming ownership of that same ounce. This is fractional reserve banking applied to commodities. And just like fractional reserve banking, it only works as long as everyone does not ask for their money at the same time. But that assumption just broke, because after Shanghai failed to deliver 98% of the requested metal, every futures holder in the world is thinking the same thing. I'd better take delivery now before the vault runs dry. The January delivery notices have not been fully published yet, but the preliminary data is already showing a massive spike. We are seeing delivery requests up 60% compared to the same period last year. 60%. And January is historically a slow month for deliveries. If this pace continues into February and March, the registered inventory will be completely drained by the end of the first quarter. Now here is where it gets terrifying. The COMEX has two options when they run out of registered inventory. Option 1, they can pull metal from the eligible category. Eligible inventory is silver that is stored at COMEX-approved vaults, but is not available for delivery because the owners have not designated it as such. As of last week, there are about 100 million ounces in the eligible category. So, theoretically, the exchange could ask those owners to convert their eligible metal to registered and use that to meet delivery demands. But here's the problem. Those owners are not stupid. They know what is happening. They know that if they make their metal available, it will be immediately grabbed by desperate buyers. So why would they sell at $92 when they can wait 3 weeks and sell at $120? They would not, and they are not. The data shows that eligible inventory is actually declining, not increasing. People are pulling metal out of the COMEX system entirely. They are moving it to private vaults. They are taking personal possession because they do not trust that the exchange will survive the coming squeeze. This brings us to option 2. The COMEX can declare force majeure and cash settle all contracts at the last traded price. This is the nuclear option. This is what happens when the system admits it cannot deliver. And if they do this, the paper price becomes meaningless overnight. Because once the exchange says we are not delivering metal anymore, we are just writing checks, every industrial buyer on Earth will realize that COMEX futures are worthless. And they will flood into the physical market, driving the real price to levels we have never seen. So the timeline for COMEX failure is simple. If delivery requests continue at the current pace, the registered inventory will hit 0 by mid-March, maybe late February if the panic accelerates. That is 6 to 8 weeks from today, 6 to 8 weeks until the second largest silver exchange in the world runs out of metal. And when that happens, the $7 gap between America and China disappears completely. Because there will be no American exchange price. There will only be the price that physical dealers are willing to sell at. And that price is going to be whatever the market will bear. Now let me tell you what the smart money is doing right now. They are not waiting for the COMEX to fail. They are not waiting for confirmation. They are acting this weekend. The large institutional buyers, the family offices, the sovereign wealth funds, they all saw the American price hit $92. They all did the same calculation I just showed you. And they all reached the same conclusion. The window is closing. The arbitrage is dying. The time to secure physical metal is now, not later. So they are calling their dealers. They are wiring money. They are taking delivery. And every ounce they pull out of the system makes the crisis worse for everyone else. This is the bank run dynamic. The first people through the door get their metal. The middle people get their metal, but they pay a huge premium. The last people get nothing but a cash settlement check. And right now, we are transitioning from the first group to the middle group. The early movers already secured their positions in December when silver was at 75. The smart money is moving now at 92. The dumb money will try to move in February at 110 and discover that the dealers are sold out. The desperate money will try to move in March and discover that the COMEX has declared force majeure. Which group are you in? Because that question determines whether you profit from this crisis or get crushed by it. If you own physical silver, you're in the winning group. You already have the asset. All you have to do is hold and wait for the reset. If you own paper silver, SLV, futures contracts, or unallocated pool accounts, you are in the danger group. You are holding a claim on metal that might not exist. And you have a very narrow window to convert that claim into actual metal before the system breaks. We need to talk about what happens when the gap closes and why $100 is just the beginning. Here is what happens when the $7 gap closes completely. And I need you to understand this because the next 2 weeks are going to determine whether you are on the right side of the biggest wealth transfer in commodity market history. When American silver and Chinese silver are trading at the same price, when the arbitrage window is fully closed, the market is going to realize something terrifying. There's only one global price for silver. And that price is not determined by the COMEX. It is not determined by the futures market. It is determined by whoever has physical metal and is willing to sell it. Right now, the Chinese price is $99. The American price just hit $92. Now that is a $7 gap. But 6 weeks ago, that gap was $14. It was cut in half. At this rate of convergence, we are looking at 3 weeks, maybe 4, before the prices meet. And where do they meet? They meet at the higher number, not the lower number, because you cannot arbitrage down. You cannot force a Chinese dealer to sell silver at 92 when his local market is paying 99, but you can force an American dealer to raise his price to 99 when buyers are willing to pay it. So the convergence happens upward. 92 becomes 95, 95 becomes 98, 98 becomes 102, and suddenly we are through the psychological barrier that everyone said was impossible. $100 per ounce. Let me tell you what happens when silver breaks 100. The mainstream media wakes up. Right now, silver at $92 is a story that gets buried on page 6 of the financial section. But silver at $100 is a headline. It is a CNBC breaking news alert. It is a Bloomberg terminal pop-up notification. And when the retail investors see that headline, when they see silver break 100 for the first time in history, they panic buy. Not because they understand the supply deficit, not because they did the vault math, but because they see a number with 3 digits and their brain says, this is going higher, I need to get in now. That retail panic buying is the gasoline on the fire, because those buyers do not want futures contracts. They do not want ETF shares. They want coins, they want bars, they want something they can hold. So they call the dealers. And the dealers look at their inventory and realize they have maybe 2 weeks of supply left at current demand. So what do? They raise premiums, they raise prices, they start rationing sales. And the premium overspot, which is already $15 to $20, goes to $30, $40, $50. At that point, the paper price becomes completely disconnected from reality. The COMEX might show $105, but if you want actual metal delivered to your house, you are paying $150. That is the 2-tier market that we have been warning about. And once that 2-tier market is established, it never goes back. Because the people holding physical metal realize they have the only thing that matters. They're not going to sell it for paper currency that is being printed into oblivion. They are going to hold it and wait for the system to break completely. This is the end game. This is the moment when silver stops being a commodity and becomes a monetary asset again. Now let me tell you what you need to do this weekend. If you own silver ETFs like SLV, you need to make a decision right now. Not Monday, not next week, right now. Because the risk reward has fundamentally shifted. 2 months ago, holding SLV was a reasonable way to get exposure. Today, after Shanghai failed to deliver, after the American price jumped to 92, after the COMEX registered inventory dropped below 30 million ounces, holding SLV is a gamble that JP Morgan will honor the physical backing when the squeeze hits. Are you willing to take that gamble? If the answer is no, you need to exit your ETF position and convert to physical metal. Yes, you will pay a premium. Yes, it is inconvenient, but you will own the asset. And in a world where exchanges are failing to deliver, ownership is the only thing that matters. If you own physical silver, the decision is simple. Do not sell. I do not care if the price pulls back to 85. I do not care if the talking heads on television say the rally is over. The fundamentals have not changed. The vaults are still draining. The industrial demand is still growing. The geopolitical tensions are still escalating. Every pullback is a gift. Every dip is an opportunity for the people who missed the move to 75 to get in. But you are not those people. You already own the metal. Your job is to hold through the noise and wait for the reset. If you want to buy silver and you do not own any yet, you have a very narrow window. The premiums are going to get worse before they get better. Dealers are already charging $18 to $20 over spot. By next week, that could be $25 to $30. But even at those premiums, it is worth it. Because the spot price is a lie. The spot price is the price of paper. The premium is the price of reality. And when the COMEX fails, when the ETFs cash settle, the only price that will matter is the price of physical metal. Pay the premium. Secure the metal. Do it now. The arbitrage window is closing. The $7 gap between America and China is disappearing. The COMEX registered inventory is draining. The delivery requests are spiking. The timeline is measured in weeks, not months. This is not a drill. This is not fear-mongering. This is the most serious warning I have given on this channel. The global silver market is breaking in real time, and you are either positioned for it or you are not. Monday, January 20th, 2026, will be remembered as the week the world realized that silver at $92 was cheap. Subscribe so you do not miss what happens next. Drop a comment and let me know, are you holding physical or are you still in paper? Where are you watching from? The gap is closing. The choice is yours. This is your Asian guy from JW Capital.